Welcome, ladies and gentlemen, to our regular 6-minute strategy from me, Guy Munson. Inflation data in the US and Europe has been steadily falling for the last 18 months, but the rate of decline, particularly in the US, has slowed in recent months. Adjusting for different methodologies across countries, inflation probably averages around 2.5% today across Europe and the US. Still modestly above central bank's 2% target, but transformed from the peak of over 10% back in June 2022. In the UK, the inflation report was notable this week. The headline rate fell sharply to 2.3% for April, the lowest since the summer of 2021. While this was not as low as forecast, it is though below rates in the US, the Eurozone and Japan. Breaking down the numbers in the UK, the message is clear. While goods prices are now negative, lower China export prices are helping, challenges remain in the service sector, where inflation at 5.9% still remains stubbornly high. This was led by price rises at hotels and restaurants, impacted by the 10% rise in the minimum wage, alongside mobile phone contracts and train fares. So yes, the last mile towards 2% inflation was always going to be tough, but what will it take to close the gap? We will consider this in the slides ahead and see what it means for interest rates and for your portfolio. So let's begin by looking at global inflation rates in the left-hand panel. And you can see there that dark blue line, the UK CPI, top of the pack back in 2022, peaking at over 11%, now falling sharply and with this big drop in the last month down to 2.3%, the lowest of the pack today. If you look closely at the dark blue line, the US, you can see that over the last 3 or 4 months, it's broadly been flatlining, if anything slightly ticking up. And that's what's been worrying the Federal Reserve. Put all these indices together on a harmonised basis, that's with similar methodology, which the UK Office of National Statistics has kindly done, and you find that actually inflation is remarkably consistent across markets. In the UK, France, Germany, EU 27 and US, it's sitting at broadly 2.5%. That's 0.5% above central bank targets, and that's the gap we've got to seek to narrow. So how can we do this? Well, let's look first at those US numbers and break them down in a little bit more detail. The good news is the light blue number, that's goods, which is actually falling in price, deflating. That's probably because cheaper Chinese imports are hitting global markets. The stubbornly high number shelter, that's owner equivalent rent or house prices, that's beginning to roll over, but it's still high at 5.5%. The worrying number is that dark red number, that services ex-housing, and that's where labour costs are really pushing up prices. Restaurants, health and household insurance, hotels, personal services like gyms and airfares. That's what the Fed's got to bear down on. Now there's some argument to say they're being successful. We're beginning to see those excessively high salary increases we saw on reopening beginning to normalise, with the employment cost index not far from the 4% level, which takes us into that band of 3 to 4% wage rises, which is probably consistent over the last 30 years of the US economy. And yes, just holding rates at their current level, which the Fed is doing, that's higher for longer, is having an impact on labour markets. On the left-hand side, you can see the well-watched measure quits as a percentage of employed people. That's workers who are confident enough to go and quit their job and take a new job. You can see that falling quite sharply back to pre-COVID levels as job confidence begins to wane a little bit. Another forward-looking indicator is the average growth in wages advertised in job postings. That rose to above 9% immediately after reopening. Look at it today, down to a much more stable 3% going forwards. I'd also echo that the underlying pressure in supply chains, which has been such a problem, is still very muted. Supplier delivery times look good. Supply chain pressures, that's shipping and transport, are still at pre-COVID levels. The Red Sea effect and the Houthi attacks on shipping not really damaging overall global trade. On the right-hand side, gas prices still stable, and if anything, oil prices rolling over quite sharply over the last 6 to 8 weeks. Let's switch our view to the UK here and see if the same arguments apply. Well, I've broken down that good 2.3% CPI number into its constituent parts, and you can see the big number that's reduced to those dark blue lines. That's housing and utility bills. That's mainly the 12% decline in the energy price cap. Food and alcohol, the yellow line beginning to narrow sharply, and that dark blue line goods going negative. The problem number is still the green number, that's services ex-housing, Very much as in the US, hotels and restaurants, mobile phone contracts and train fares. And of course we in the UK had a sharp 10% rise in the minimum wage that put a lot of pressure on catering and other low-end jobs. So what does all this mean for interest rates when we wrap it up and in turn markets? Well, I've shown here for the US and UK the central bank implied policy rates, that's the direction of interest rates that the markets are betting on. For the US first, we've currently got interest rates at 5.25% to 5.5%. Back at the beginning of the year, we expected 5 or 6 rate cuts down to 4%. Now we expect them to go to 5%, so just 1 or 2 rate cuts. In the UK, base rates are 5.25% today. At the beginning of the year, we thought they'd fall below 4. Today, we think 4.75 or so. So 2 rate cuts. We probably here at Saracen are a little bit more dovish. We think we might see a 3rd or even a 4th going forward. All this has meant that bond markets are range trading as they get an idea of the midterm trajectory of interest rates as this inflation effect passes through. So let's wrap this up. Yes, inflation is still above target, but there's a good chance that central bankers can bear down on wage rates and so on that underlying services number that's so worrying us. If that's the case, then we've got a reasonably robust global economy, some good earnings around the world. Yes, it's a bit tech concentrated, so we've got to embrace a wider market, but it's broadly good for equities and risk assets going forward. Well, I hope that's helpful. I hope it's helpful for your portfolio and your outlook for interest rates in the UK and US. Thank you.